What's up everybody, I am Jaspreet Singh and there are two types of investments you can make. You can invest your money for appreciation or you can invest your money for cash flow, aka passive income. When you invest your money for appreciation, you buy an investment like a stock for $100 a share and you want it to go up to $200 a share so you can sell it for a profit. When you invest your money for cash flow or passive income, now you're investing your money, you invest $100 and now in exchange for making this $100 investment, you want to get cash flow every single year for owning that investment, and this is cash flow that you get without having to work to make this investment pay you, and it's without having to sell this investment. True financial freedom is when you have enough cash flow or passive income coming in from your investments to pay for your expenses, and the time where people want this passive income the most is when you're in a slowing economy or a recession. However, the time where people ignore getting and creating passive income is when they are in a recession. However, in a recession, it is one of the best times to start creating this type of passive income. The best way for me to explain this is by giving you an example. So let's assume now that you invested in the McDonald's stock. Now, I'm not telling you what to invest in, just giving you an example back during the 2008 crash, because in 2009, the McDonald's stock, along with the entire stock market, bottomed out, and McDonald's bottomed at just over $50 a share. It was about $52 a share for the McDonald's stock, and during this time when the stock fell down to about $50 a share, they were still paying about a $2 annual dividend. It was a little bit higher than $2 a share, but let's just say $2 a share for the annual dividend to keep things round. Now, if you went out and you took $10,000 and you bought shares of this McDonald's stock, you would have purchased something like 190 shares. So $10,000 would have bought you 190 shares of the company, which in 2009 would have paid you $380 worth of cash flow in 2009. Not a life-changing amount of money, but it is some cash flow. However, if you held on to the stock from 2009 through July of 2022, so you didn't sell it at the peak in 2021, you still wrote it down, and now in July of 2022, well, your stock would have gone up in value, because in July of 2022, the McDonald's stock went up to $250 a share, and their dividends also increased from $2 a share up to $5.50 a share. So your investment, which was $10,000 at this time, grew in value to about $50,000, so about 5x your investment. And then your cash flow also increased because you bought it at a $2 annual dividend. Now they're paying a $5.50 annual dividend. So this 190 shares that you bought back in 2009, which was paying you $380 a year, is now paying you almost 3 times more today, assuming you didn't buy any more shares, assuming you didn't do anything, and now your investment is paying you about 3 times more in your cash flow. So just over $1,000 a year, between $1,000 and $1,100 a year in cash flow, assuming that you did not buy anything else. If you bought $100,000 worth of shares back in 2009, well, the $100,000 investment would have become $500,000, and the $100,000 investment would be paying you almost $1,000 a month today. Now at this point you might be thinking, but Jaspreet, how am I supposed to have $100,000 in the middle of a recession to go out and buy the stock to start generating this $1,000 a month in passive income? Well, you're missing the point, because there are ways for you to now grow and build this sort of passive income, especially when you're in a recession. There's a few points that I want to make sure that you understand here. The first point is that when you see these types of economic downturns and these market crashes, it causes the price of pretty much every asset class to go down. Because when you have a recession, then you see the bad and toxic assets come out, and these bad and toxic assets which fail or go to near failure cause the price of good assets to come down as well. And so you have economic issues across the board which hurt the value of good assets. Now, this is where you can find the opportunity, because if you can find these good assets, you will be able to come in and purchase them at a discounted price. Now, when we talk about buying cash flow, that means buying a stock that's paying paying you a dividend. There's other ways to generate cash flow. I'll get into that in just a little bit. But when we talk about in the stock market, you're looking for a company that's paying out a dividend. And so when you're looking for a recession and a market crash, and you're trying to create the opportunity here to purchase a passive income producing investment, now what you're trying to do is you want to find a strong investment that has been hurt by the economy. So what does that do? Well, not only does it hurt the share price, but it can also hurt the amount of dividend that you're getting, because now companies' profits get hurt and they may have to cut some of their dividends. And so this can create an opportunity for you to come in and buy more shares because the price has come down. So you buy more of these shares, but then as the share price goes up, the dividend price, the dividend value, the amount of cash flow that they're giving also goes up. In this case, the stock price went up almost 5 times between 2009 and 2022, and the dividend went up almost 3 times over that same period. Remember, this dividend is cash flow that you're getting without having to do anything. You just own the right investment and it's paying you cash flow. And this is the value of your investment, because now if you wanted to generate that same almost $1,000 a month in cash flow from this McDonald's stock today, you'd have to buy about $500,000 worth of the stock today to get the same amount of cash flow you would do if you bought $100,000 back in 2009. Now, I'm not saying you have to have $100,000 to start doing this. You can start with $10,000. You can start with $1,000. You can even start with $100, and in some instances, you can even start with just $10. It doesn't matter how much money you start with. This is now building that mindset and understanding the second part, which is it's about consistency. I'm not telling you that you need $100,000 or $10,000 or even $1,000 to start doing this. What you need is the consistency and understanding what your goals are. If your goal is cash flow, it's passive income, well then what you want to do is first find the right investments. I'll go over that next. But then start buying, especially when prices come down, of good investments, and then keep buying them. Here's the thing, McDonald's was a winning investment from 2009 until 2022, but there's no guarantee that McDonald's is going to have the same type of success between 2022 and 2030. So this is where now you have to understand, how do you find a good investment? Because if your goal is cash flow, then what you want to do is you want to find a good company that's distressed, where now over the next decade you will see the price increase while also the dividends increase. And this is where either you can do the work to find an individual company, if you're willing to spend the time to do that fundamental analysis, to do the research, to research the company, to understand the cash flows, to understand the profits. But if you don't want to do that, then the next best thing is to invest your money into an ETF, an exchange traded fund, which is now a basket of stocks with the goal of investing in an ETF that's giving you high dividend yields. Here's a few high dividend ETFs that you can consider. Now, I'm not telling you what to invest in, just giving you a few examples so you know where to start. HDV is the iShares High Yield Dividend ETF. SCHD is the Charles Schwab High Dividend Yielding ETF. VYM is the Vanguard High Dividend Yield ETF. And VYMI is the High Dividend ETF by Vanguard, not for companies in the United States, but for emerging markets. So this is investing in countries and companies overseas that are paying higher dividends. You can many times see higher dividend yields here. However, this comes with much higher price volatility, because now you're investing in companies that are outside of the United States that are transacting with currencies that are not the United States dollar. So you have a lot more volatility here. But now this gives you something to start with if you're looking to invest your money in these types of dividends, because now as prices go down, this can give you the opportunity to come in and buy more shares at a discounted price, and then you can keep buying these shares consistently every week, every 2 weeks, every month, and you keep doing this over a long period of time. Because if you really want to build cash flow, you want to build passive income, it's a long-term, consistent strategy where you have to do this every single month for a number of years. And then what you'll see is you'll keep accumulating more shares, and now over time, as the markets rebound, as the economy rebounds, your dividends grow, and now you're getting higher dividends even if you're not actively buying more shares, just because your shares have become more valuable, and each individual share that you own is paying you a higher profit distribution, a higher dividend. Now, before moving to the second way that that you can start generating this type of passive income when you're in a recession. If you do want to learn more about how to generate passive income and want to see a step-by-step guide on how to do that, I wrote a free ebook on how to start generating passive income that you can read. So if you want to learn more about how to start generating passive income, you want to see how you can do it, and you want to start doing it today, well, then you can read my free guide to generating passive income, and I'll put the link for you to how you can download it down in the description below. Now, let's move on to the second way that you can generate passive income during a recession, and this is through real estate. Now, we all know how real estate investing works if you've been subscribed to this channel. If you're not subscribed yet, make sure you do that. You can buy, for example, a home like this for $150,000. Yes, you can find $150,000 homes in the Midwest. And if you buy this home for $150,000 today in this market, you could rent it out pretty easily for $1,500 a month, maybe more, maybe less, just depending on the home. However, if you go into a market crash, you go into a recession, then you can also see home values drop. Now, the one caveat that I do want to give you on this is that home prices are a lagging asset. Compare that to something like the stock market, where when people get worried, they panic, they get scared, they can sell immediately, and you can see the stock market fall very fast. I mean, you can buy and sell a stock in a second, versus it can take 30 days, 60 days, 90 days, a year to sell a real estate property. So real estate is much slower moving than the stock market. That's why we saw the stock market bottom in 2009 when the 2008-2009 crash happened, versus real estate bottomed in 2012, 3 years after. By the time real estate hit its bottom, the stock market was hitting new highs. So that's one thing that you want to be aware of when it comes to real estate. However, the advantage of real estate is you own a physical hard asset. Now, the way it works here is if you go into a recession and home values go down, well, now the price for this asset would go down as well. Now, instead of paying $150,000 for it, maybe you're paying $120,000 for the same property. Obviously, the 2008 crash was an anomaly where property values had lost somewhere between 50 to 90% of its value in some instances even more than that. There were some properties that I bought that were like 92% off of their highs previously. Now, what also happens is rental prices do go down as well, because when you go into a recession, then people don't have the ability to pay the same rent that they did before. So a lot of times you'll see rent prices come down. So maybe this will go down to $1,200 as well for rent. So you're buying this property for $120,000 that you can rent out for $1,200 a month. But there's some extra advantages that you get for buying a property at a cheaper price than just being able to ride the price up and ride the rental price up as well, because there are other expenses that come with the property. Like when you buy a property, especially if it's beat up, it needs renovation, well, you have to pay for these renovations. And these renovations are cheaper when you're in a recession, when people need work, because now contractors are going to be more likely to give you a discount or a concession because they need that work. And the second thing has to do with property taxes. Now, this marker is dying. I got to get a new marker. But with property taxes, your property taxes are based on the property value, the price of the property. And the interesting thing about property taxes is a city has the ability to raise your property taxes. However, there's a limit to how fast they can raise your property taxes. Now, this varies from jurisdiction to jurisdiction, from city to city, but generally this is somewhere between 2 to 5%, which is the maximum that they can increase your property taxes. However, if you sell the home, meaning you recapitalize the home, you recapture the home, your property taxes can readjust. So now, if you bought this property at $150,000, your property taxes are going to be a lot higher than if you bought the property at $120,000. However, if you buy the property for $120,000 and then the property value goes up to $150,000 next year, well, your property taxes aren't going to go up as much as they would have if you bought the property for $150,000. So when you can buy properties at a discount, well, yeah, you get to buy the asset at a discount. Hopefully you're buying it in a good area where property values are going up and rental prices are going up, but also your expenses, things like property taxes, aren't going to be going up as fast as some of the other expenses because cities have limits to how fast they can raise your property taxes. So you're buying this asset for one purpose, to generate cash flow, this sort of passive income, because now this rental income that you're getting, this $1,200 or $1,500 a month, this should, if you do it right, cover your property taxes, your insurance, your maintenance, your management fees, and any mortgage costs that you have, and then put some money in your pocket. Now you might be wondering, Jaspreet, is real estate investing really passive? Well, it depends on how experienced of an investor you are. When I first started investing in real estate, I had no idea what I was doing. I didn't have any real estate investor family members. I didn't have any guidance. I had to figure it all out myself, and it was anything but passive. But now it's completely passive, because I hand everything off to my property management companies. I work with more than one company, and so they handle all the day-to-day work. I don't know the names of my tenants. I don't know when my tenants file complaints or issues, because we have a process, we have a system. So when something goes wrong, they call up the property management company. The property management company will send over a contractor. All I do is every month and every quarter, I read the reports that my managers send me. And so it's passive once you can build the systems, once you can build the team. But until there, it's not passive. Now, thanks to the internet, there are other ways for you to invest in real estate that's much more passive. There's crowdfunding real estate services on the internet, which make it significantly more accessible. I have some in our description if you want to see some of our affiliates and sponsors, where now you can get real exposure to real estate investments without having to go out and physically buy properties, without having to deal with all the headache. And then you can like dollar cost average your way into real estate. So thanks to the internet, there are other ways for you to get exposure to real estate investments without having to deal with all the headache of real estate. But the whole idea here of investing in real estate during a recession is now you are looking for the opportunities where home prices are going down. And then that's where you can come in and buy properties at a discounted price. That way then you can just ride the wave upward. The third way that you can generate cash flow, this one I'm not gonna say passive income, but I'm gonna call this one cash flow, is by buying a business. Now, when you go through a recession, when you go through an economic slowdown, what happens is you see people running businesses with too much debt, with too many toxic assets, that don't know how to manage their company, that will then run the company into the ground, or the company will go into the ground because of the economy. You see this very apparently in the real estate market, because if somebody owns an apartment complex, they don't know how to manage it, they have too much debt, tenants start to leave, well then they get underwater on their apartment, and then they can be forced to foreclose and sell their property at a discount. Well, you see the same thing happen with businesses, where somebody might buy a business or start a business, and they might have a good product, they might have a good thing, but then if they have too much debt, they don't know how to manage the employees, they don't know how to manage the business, they don't know how to manage the infrastructure, then the business can start going downhill, and then they could be forced to sell by a bank, or maybe they just want to sell and get out as fast as possible because they hate it and they don't like managing it, especially during a downturn. Well, this can create opportunity for you. However, this one will require probably the most legwork, and it can take a lot of capital. Although, just like with real estate, there are creative ways for you to get involved with businesses, to purchase businesses or shares of businesses, even if you don't have a lot of money. Now, many times this is usually going to involve something like sweat equity, where you have to work your equity into the deal, where you have to work there to build your equity, or it's going to involve some sort of creative financing, where now the seller is now financing the purchase of their own business to you. If you have no business experience, then it can be very risky for you to go out and take a loan or seller finance to go out and buy a business. But if you have business experience, this can create opportunity for you. Now, there's a bunch of different platforms on the internet where now you can find businesses that are looking to be sold, that are looking to sell, and you can also potentially work with a business broker that's looking to sell these businesses. The whole idea here, just like with real estate, is you want to buy a business, an asset that's generating a certain amount of cash flow. Let's just assume $1,000 of profit a month. Well, in business, you are going to get a higher return dollar for dollar than with real estate, because with business, then you got to actively be involved in the business. So in this case, if a company is making, say, $1,000 a month, $12,000 a year, this business might sell for $36,000. It could also potentially sell for $360,000. Now, the thing that makes the difference here is going to be, one, what kind of business it is, how they're generating the money, what type of innovation they have, what kind of patents they have, if any, what kind of machinery and infrastructure they have. And then the second issue is going to be what kind of economy that we're in. And so you can't change what the business does. I mean, this is going to be where your interest lies to see what kind of business you want to potentially purchase. But then the second thing that you want to pay attention to is the economy, because the economy is going to play a factor into valuations. When the economy is booming and when inflation is hot, this pushes valuations higher. But when the economy is contracting and you're seeing this fight on inflation, interest rates are rising, well, then that can push valuations for businesses down, assuming no change in the business. So this is where now you have to understand, one, do you want to invest in a business? Do you want to buy a business? I personally have never bought a business, the entire business. I have invested in many startups. There's a bunch of different platforms on the internet. You can look at Republic, you can look at Start Engine, you can look at WeFunder. I do have to let you know that I am an investor in WeFunder, but there's a bunch of these crowdfunding platforms on the internet that allow startups to raise money from regular people, investors. So I do, and I have invested in a number of different startups, but I've never invested in a business like that before. I know people who have purchased businesses, and it's a way for you to now generate cash flow, but it's not passive cash flow. This is a way for you to now actually buy the business, run it, and if you can buy it during a recession, well, now you can get a discount. And if you know how to run the company, if you can grow the company, now you can grow the valuation of the company and grow the revenues without even increasing the business that much, because now you're just kind of riding the wave of the economy. But of course, if you don't want to deal with the headache of actually managing the business, then the next best thing would be for you to invest in startups, like with the companies that I talked about, where now you're investing in the startups. This is now a passive investment on your end. However, it's significantly more risky, and you're not getting any sort of cash flow or passive income, because now you only get paid when you invest in a company that gets acquired, meaning they get bought by another company or they go public. So if you invest in a startup, well, then it's not cash flow. However, you can see a big return if they get acquired or if they go public, but there's also a chance that that will never happen, so your money just disappears. So it's high risk, high potential reward with no cash flow. So you got to figure out what type of investor you want to be. But just like that, you can see more opportunities there, because when companies need cash, they will be willing to sell a piece of their company at a discount, and that can happen either because the company's struggling or because the economy is struggling. So this is where you want to find the opportunities where when the economy is struggling, you can come in and get a discount on the investments that you make. If you enjoyed this video and you want to see the 5 steps to force your way out of poverty, I already made a video covering this, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. If you really want to build true, sustainable wealth, it takes time. And a lot of times we overestimate what we can do in